Good morning students. We are going to start with Unit 5, Reserve Bank of India Regulation in our banking. We all know that Reserve Bank of India is an apex institution and a central bank to our country. In this particular unit, what we are going to study is the functions of RBI. As RBI we know, it's a financial supervision. Financial supervision means the whole soul, being the central bank of our country, supervising the whole financial department of our country is in the hands of RBI. Monetary management, that means all monetary related aspects, budget, financial things, financial expenditure and financial, whole things will be managed by RBI. Issuer of currency, that is the currency chest of our country. It has got the power to issue currency in our economy as per the cash flow of the things. Banker to the government and banker to bank. Very important. All the government, like state governments, UP government, Delhi government, all the states has got an account with RBI. RBI is not dealing with any individual human persons, but it is dealing with on a very macro level, that is banker to government. All the states, all the union territories will be having a particular account with a RBI. Banker to bank. Without the banker's license, no commercial bank, RRB or any other cooperative bank has got a permission to start or do financial business of banking in country. So they must have to have an account with RBI, and that's why it's being called as a banker to banks or a lender of last resort banks. Formulate monetary policies, all related policies. For a bigger example, you can just see the demonetization policy is also being framed by the Government of India and RBI. So formulation of all the rules, regulations and what need to be executed and followed is through RBI. Manager of foreign exchange, what money, dollar, yen or whatever the type of things coming into our country and going out of our country, everything is in the hands of RBI. RBI also playing a very important developmental role, that financial growth of economy is in the hands of RBI and RBI's regulations. So RBI needs to see and check whether the inflation deflation is there, how the country needs to increase their GDP. So these are your basic functions of RBI. Now we need to learn in this particular chapter a very important thing, that RBI, when we say making a regulations and supervisions, there are certain tools through which RBI is helping the economy to maintain their financial supervision. So there are two tools in the hands. One is qualitative measures, another one is quantitative measures, through which RBI basically helps to regulate the financial security and developmental role in our country. Quantitative or general methods include bank rate, open market operation, change in cash reserve ratio, statutory liquidity ratio, repo reverse ratio, and qualitative is selective credit control, rationing, moral persuasion and direct control. Out of this, first of all, cash reserve ratio. What is a cash reserve ratio? Since every bank is having an account with RBI, they need to reserve cash with RBI for the financial liquidity. When we say if a bank fails, we have a right to go to RBI to get our claims. So how RBI is going to fulfill your claims? Only because RBI is maintaining a cash reserve of each and every bank in his account. So it is helping every single person to maintain that. Next one is statutory liquidity ratio. Every bank needs to maintain a cash for meeting the demand deposits of the persons. So that is statutory liquidity ratio that RBI wants every single individual person. How they are going to maintain? Again, the list has been given by RBI to those banks to maintain their SLR in different forms, like cash at hand, current account balances with SBI and other public sector commercial banks, then gold valued at price not exceeding the current market prices. There are certain number of securities which will be counted in the list of SLR to be maintained by commercial banks with RBI. To restrict the expansion of banks' limit, to increase the bank's investment in approved securities and to ensure, very important, the solvency of the banks is the main objectives of SLR to be maintained. Bank rate. Bank rate is the standard rate at which the RBI is prepared to buy or rediscount the bills of exchange or other eligible commercial papers from banks. So it is a basic rate of rediscounting and refinance facilities from RBI. Change in bank rate by RBI affects interest rate on the loans, interest rate on deposit across the fund. So same direction. Now coming up to the next, that is repo rate. Repo rate and reverse repo rate, a very important items and a very important tool in the hands of RBI to maintain this. The rate at which the bank borrows short-term funds from RBI is called repo rate. Such funds are provided on the promise of market dispersed repurchase of approved securities by bank. So SLR securities are sold to RBI by the commercial bank to meet their immediate needs of funds for maintaining their CRR and SLR, and it is a promise by the bank to RBI that they will repurchase this security. So this is repo rate. Second, the bank buys back the same securities after a day or few days. The price for buying them back is pre-decided. When the repo transaction is agreed upon, the difference between the prices of the two legs thus is the borrowing cost of the borrowing bank. A repo transaction is meant to meet only the short term or a single day or a few days requirement of banks. A reverse repo rate is the opposite of repo. RBI announces the repo rate and reverse repo rate. The reverse repo rate is always lower than the repo rate, so that the bank pays an extra amount of money to RBI for getting the things. Repo versus bank rate. Two parties are constantly involved, the central bank and the commercial bank. Both repo rate and bank rate helps the bank to raise funds from RBI. Both indicate the cost of funds to the bank. Bank rate is changed when the bank borrows funds or rediscounts in the normal course of business. Base rate. We must have understood in our unit 4 about the floating rate of interest and fixed rate of interest. When we were talking about the fixed rate of interest, we have taken as a two advantage. One is base and another one is range. So it is important to understand the word base rate. Base rate, that is BPLR, means benchmark prime lending rate system, which introduced in 2003. It fell short of original objective of bringing transparency to lending rates. So hence, bring transparency to lending rates, RBI made it mandatory for all banks to introduce base rate with effect from 1st July 2010. So this is important to understand that base rate is being decided by RBI. Over and above that, the range will be charged by commercial banks to get the amount of profit in those transactions. So this is whole for this particular chapter, and we will start with unit 4 in the next class.